The Detrended Price Oscillator, DPO, is a technical indicator that removes long-term trends from price data to highlight short-term price cycles and volatility, allowing traders to identify potential overbought-oversold conditions and estimate cycle duration. Unlike traditional momentum oscillators, the DPO is not a trend-following indicator. It uses a displaced simple moving average, SMA, to shift historical price data, revealing fluctuations around a zero line. Traders interpret a DPO above zero as bullish and below zero as bearish, but it's best used with other indicators for confirmation. The Detrended Price Oscillator, DPO, removes a long-term trend from price data by subtracting a displaced simple moving average, SMA, from the current price to focus on short-term price cycles. Traders use it to identify potential price turning points, overbought-oversold conditions, and the average duration of cycles by observing its oscillation around a zero line. The Detrended Price Oscillator, DPO, is a technical indicator that uses a displaced moving average, DMA, to filter out trend-related noise, allowing traders to focus on short-term price cycles, overbought-oversold conditions, and market reversals by showing the difference between the current price and the displaced moving average. The DPO oscillates around a zero line, with values above zero suggesting potential upward momentum and values below zero indicating potential downward movement. The Detrended Price Oscillator, DPO, calculates the difference between a past closing price and a displaced simple moving average, SMA, to identify price cycles. The formula is Detrended Price Oscillator is equal to closing price, n/to +1, periods ago, n period SMA. You take the closing price from n/to +1 periods ago and subtract the SMA of the last n periods from it to get the DPO value. The Detrended Price Oscillator, DPO, helps identify price cycles by removing long-term trends, focusing on short-term, cyclical price movements. It works by calculating the difference between the current price and a shifted simple moving average, SMA. When the DPO crosses its zero line, it signals changes in the cycle's direction, and peaks-troughs in the DPO correspond to peaks-troughs in the price, allowing traders to estimate cycle length and potential turning points. The Detrended Price Oscillator, DPO, identifies overbought and oversold conditions by oscillating around a zero line, with extreme readings indicating potential reversals. When the DPO is at extreme positive values, it suggests overbought conditions and a possible price reversal to the downside, signaling a potential sell opportunity. Conversely, extreme negative DPO values indicate oversold conditions and a potential price reversal to the upside, suggesting a buying opportunity. To time entries and exits with the Detrended Price Oscillator, DPO, look for zero-line crossovers, cycle peaks and troughs, divergences, and overbought-oversold conditions, but always confirm these signals with other technical tools. An upward zero-line crossover is a potential buy signal, while a downward crossover is a potential sell signal. Peaks in the DPO suggest potential overbought conditions, time to sell, and troughs suggest potential oversold conditions, time to buy. To estimate a market cycle's length using the Detrended Price Oscillator, DPO, look for repeated peaks and troughs in the DPO indicator. The time duration between successive peaks, or successive troughs, on the DPO line provides an estimate of the underlying cycle length for that market. Traders can then use these historical cycle lengths as a benchmark for anticipating future price action. The Detrended Price Oscillator, DPO, is not a standalone confirmation tool. Instead, it is used in conjunction with other indicators and price action to identify potential market turning points and confirm trends by isolating price cycles from the noise of long-term trends. Traders use DPO's zero-line crossovers for potential signals and observe extreme high-low points to spot overbought-oversold conditions and potential reversals. To confirm a DPO signal, traders look for the DPO moving back toward the zero line, confirming price action, and using additional indicators. The Detrended Price Oscillator, DPO, is a technical indicator that highlights short-term price cycles by removing the long-term trend from price data, allowing traders to focus on oscillations between peaks and troughs. It achieves this by calculating the difference between the current price and a moving average of past prices that is shifted to the left. The DPO's primary use is identifying potential turning points and overbought-oversold conditions within a cycle, but it's best used with other indicators for confirmation, as it's not ideal for timing trades on its own. The Detrended Price Oscillator, DPO, is not considered a momentum oscillator because it is backward-looking, shifting price data to the left to remove the trend and focus on short-term price cycles and volatility, rather than measuring current momentum or speed. Unlike momentum oscillators that directly track the rate of price change, the DPO isolates cyclical patterns by measuring past price deviations from a displaced moving averages. The Detrended Price Oscillator, DPO, is a lagging indicator because it uses historical price data to calculate the difference between a past price and its corresponding simple moving average, SMA, a process that relies on previous market activity to identify cycles. It is a lagging tool as it reacts to past price movements rather than predicting future ones.